Welcome back to Traders Corner, Summit's exclusive weekly trading show. As always, our guide through the markets is Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi.
Garth, it's been quite a choppy week. What with the Greek elections and I suppose the Fed's announcement tomorrow night, whatever it may be. I think a lot of people expecting some new form of monetary alchemy. What is your take on the markets at the moment?
Yeah, it certainly has been quite volatile of late. Obviously going into last weekend, there was a big concern around the Greek election and what the result would be. We always knew it was going to be a very closely fought race. In the end, the result was favourable for now. It allows the Greeks to stay in the Eurozone, and they've been talking about a coalition government and now renegotiating the terms of the bailout package. So I suppose it kicks the can a little bit further down the road for Greece, and they stay in the Eurozone for now. I certainly don't think it's the end of the troubles for Greece, however. I mean, I think economically they're still in a very bad way, and it's difficult to see how they're going to come out of this in a hurry. And having said that, I think it's also certainly not the end of the Eurozone problems. I think there's still plenty of trouble to come in the Eurozone over time.
Spain.
Yeah, Spain now looks like the next one that the markets are attacking. Their bond yields are now trading up above 7%. Although having said that, they did have a successful bond auction this morning. But the 7% bond yield on the 10-year yields was the level at which Greece needed a bailout, and Ireland and so on. So now Spain has gone above that 7% level. So it'll be quite interesting to see. I know their economy is slightly different, but they've still got very similar problems to what's happening in other parts of Europe. And I don't think the Eurozone issues are over, not by a long shot. Okay,
so if this is the context for sort of a bigger picture look at the all-share at the moment, I know you want to pull up a chart then and tell us what it's showing, and before we get to this week's trade.
Yeah, okay, well, I've got a chart of the all-share index up at the moment, and it just shows the last couple of, in fact, all of 2012's trading action. And you can see for the most part we've actually gone sideways in quite a choppy, messy sort of range. Obviously this is a reflection of the whole market, and within this we've got very divergent sectors. We've got very weak resources and very strong industrials and financials. But the net result for the all-share index is a market that's been going sideways. But if you have a look, and we put a little bit of technical analysis on here, you can see that we've got what is sort of looking like a broadening formation over there. And we bounced off the bottom of that formation, and we've now started to head up. And at the moment we look like we're heading back up towards the top of this broadening formation, which would come in at about 34,700 on the all-share index. Also, if I have a look there, I see an inverted head and shoulders over the last month or 6 weeks, I suppose, and you can see it clearly labelled there. Now we've broken above the neckline of that inverted head and shoulders pattern, which is the neckline is the dotted line there, and that now projects a move higher. As I say, the first level of resistance I think will be at about 34,700, but that inverted head and shoulders pattern actually can project up to around about 35,000.
So it's pretty bullish.
It is fairly bullish, I guess, but in the context of a overall sideways market.
And also, as you said, woes in Europe. Garth, this is the bigger picture, but if we have to narrow it down into any one particular stock, the share that you've chosen this week is in one of the very strong shares on the JSE of the last few years. It's Woolies. Tell us why.
It is Woolies. And if you think about the way we've traded this show this year and where we've done well, it's been in the strong shares. And the strongest stocks in the market generally tend to continue leading. We've made good money on Aspen, we've made good money on Naspers, we've made good money on Brait, we've made good money on Remgro. And all of these are very, very strong stocks. They're in well-defined upward trends. They're in strong sectors of the market. And Woolies, I suppose, fits the bill in the same way that all of those stocks that I've just mentioned also are very, very strong stocks.
Although, having said that, we continually get questions about when is the time to short these stocks because they are so strong. I suppose the automatic assumption is it's got to end sometime and there've got to be some sort of pullback, but it hasn't been the case, has it?
Yeah, I know. I always sort of chuckle to myself at that sort of thought, because in a lot of these retailers people say are expensive, and they are, I suppose, expensive. I mean, on PEs north of 20 times earnings in many cases. That is expensive. Let's not beat around the bush. But having said that, a lot of the retail stocks that have been so strong, many of the analysts have had sell recommendations on them for ages. Think about ShopRite, think about Mr. Price, and so on. And yet the shares continue to move up. And I think this is where you need to differentiate between trading and investing. Trading, we're going to put a trade on here. We're betting that the momentum will continue. And the saying is the trend is your friend until it bends, right? So at this stage, the trend is still up. And when the trend changes, then we'll exit the trade, or we might need to execute a stop loss, whatever. We're certainly not getting married to the stock by any stretch of the imagination. But I think that's where the difference comes in between trading and investing.
Okay, well, let's have a look at that graph.
All right, so here we've got Woolies on the screen at the moment. What you can see is a nice steady upward trend there. I've indicated that with the trend line. Also, the green line that moves through that chart is the 50-day moving average. And you can see it's pointing up. It's been pointing consistently upwards for many, many months. Something I talk about on my trading course is that one of the very simplest little things that I've found to be successful with your trades is trade in the same direction as the 50-day moving average, because it's a good indication of medium-term trend. And in my experience as a trader, I've found often the times when I've lost money on trades have actually been times when I've traded against the direction of the 50-day moving average. So it's just a small little tidbit for the viewers to keep in the back of their minds. I think that if you align your trades with the medium-term trend and you align them with the 50-day moving average, your odds of success are significantly enhanced. So that's what we're doing here. If we have a look at this chart, then what you can see is we've had support at 48.50 on Woolies, which it's held over the last week or so. I'm just going to zoom in. That rectangular area that I've highlighted there, I'm now going to zoom in. And that's basically the last 3 months worth of trading action. And this is where I want to just take a closer look at how this chart is setting itself up. Notice there that we've got the upward trend, which I spoke about. And also notice that we've got a bull flag formation setting up over there. And we've actually broken out the top of that bull flag pattern. So what I've done is I've entered a trade for our portfolio. I've bought at 49.70 and I'm using a stop loss here at 48.60. Now that dotted line through the top there is resistance, and that comes in at around about 51.50, and I'd expect to see the stock run into a little bit of resistance at that level. So I'm buying at 49.70 with a view to running it up to about 51.50. Our stop loss is at 48.60. And then if I look at that in terms of risk to reward, I've indicated it there with the green and red blocks. The green block being the reward, the potential reward, and the red block being the risk.
Garth, is this the trade that you announced to your subscribers yesterday?
Yes, it is. I set this out on Traders Corner on the website yesterday for subscribers to see. Yesterday we said look for a break above 49.40 to buy, and that basically would have meant a break above the top of that bull flag pattern. And it actually gapped, or it didn't gap high, but it ran away quite quickly, and it was very difficult to get in at that 49.40 level. You ended up having to pay a bit more, and I've paid 49.70 for it. Yeah.
I mean, is it something that concerns you overly much, or given that you're, I suppose you can't necessarily get in at ideal levels always as a trader?
Yeah, I think you've got to be careful of not chasing a share too much. If it runs away from your entry level too far, then maybe it's best to leave it alone, because what happens then is your risk to reward ratio becomes unfavorable. So you want your risk to reward ratio to be as good as possible. So buying it at 49.70 yesterday was fine in terms of a risk to reward ratio for me. What I will say is that I've often found that if a stock is difficult to buy, like this, it became difficult to buy, well, it's actually quite a good sign, because it does mean that then there's obviously enough buyers on your side pushing the share price in the right direction.
Yeah. Okay, so going with the momentum trend, will you take us through the mechanics of this trade? Sure.
All right, so we bought it at 49.70, as I mentioned. The stop loss is at 48.60. That means I'm risking per share R1.10. All right, and I'm risking only 1% of our account at this stage.
Why?
We've got a bit of long exposure in the portfolio already at the moment, and also I think going into this week's Fed meeting, we're just a little bit cautious. Let's see, the market's already priced in a lot of possibility of some good news, and I wonder if they don't come with a QE3 type announcement or extension of their Operation Twist or something to give the market some more steroids, if you like. You could find the room for disappointment might be there. So I'm just going to err on the side of caution at this stage, and I'm just risking 1%. So with our account standing now at about 359,000 Rand, 1% of that is 3,590 Rand. And then I take it through the calculation that we always do. I divide the portfolio risk, divide it by the risk per share, and that gives us the number of shares that we can afford to buy. So 3,263 shares. So for simplicity, I'm going to round it down to 3,200 CFDs. That's what I've done for the portfolio for this week.
Okay, so one to watch. What about that put spread option? Because obviously that is going to draw to a close in, what, 2 days' time?
Yes, it's getting interesting now. You'll remember that this is a put spread option an option structure where we've got a long put option with a strike of 30,000 and a short put option with a strike of 28,000. And what it meant was that anywhere below 30,000 on the top 40 index, we would be able to start making profits. But anywhere above 30,000, we'd lose our option premium. But then I went and bought one top 40 future against it at about 29,000. So it changed the whole shape of this put spread structure by doing that. And what you've got on the screen is what is the payoff of this structure as it stands now, with 2 days to go until the futures close out. So those are the pivotal points, I guess. At 28,000, 29,000 and 30,000, you can see the different rand amounts that we stand to make with this option structure. Where are we right now? That's where we are, where the dotted line, the orange dotted line is. We're sitting at about 30,500. So we're sitting with a mark-to-market profit of somewhere around about 14,000 Rand on the whole structure at the moment. So it's going to be very interesting to see how the futures closeout settles on Thursday.
Yeah, and especially as it comes a day after the Fed meeting.
Yes.
So that could, as you said, be pivotal. But you know, you've kind of got insurance against the Fed doing something and also against the Fed not doing something.
Yeah, that's right. I mean, we've got a V-shaped payoff here from 30,000, whether the market goes up or down by quite a lot, really. We've got, I mean, for 2,000 points either side, we've got a V-shaped payoff, and we're sitting in a comfortable place right now.
But you are sitting in the comfortable place, as you said, because you bought the top 40, because you went long on a top 40
I delta hedged it, yeah.
Okay, that's getting very complicated now. But if you hadn't done it, would you actually be out of the money right now?
Yeah, if I hadn't have done that, we'd be out the money completely. Anywhere above 30,000 on this structure, it wouldn't have worked. So buying that one futures contract to delta hedge this structure down at 29,000 certainly has worked out to be the right thing to do.
Okay, guys, so what does the portfolio look like then in that case?
Okay, it looks like this. So we've got our Woolworths that I spoke about earlier. We've got our new gold ETF that we're still sitting long of there with a mark-to-market profit of 5,600 Rand. Exara, we banked all our profits. And then we've got our top 40 put spread structure and the one Aussie 40 future against that. As you can see there, we collectively we're sitting with a profit of around about 14,000 Rand on that structure. And then we've got our Naspers where we're still long half of our position there. And that leg of it is up 8,250 Rand. So all in all, it's looking good. The portfolio is sitting at 359,000 Rand. So that's up 43, almost 44% for the year to date.
I mean, that's a fantastic performance, probably one of the strongest that you've actually ever had on this show.
Yeah, it is. It's by far and away the best year that we've ever had on Traders Corner. So far, look, it's only halfway through the year. So let's not count our chickens before they hatch. But, you know, I think continuing the way I have with the right principles and stop losses and risk management and trading in the right stocks, the right sectors, and getting on the right side of the momentum, generally speaking, I'm still confident that we've got good times ahead of us.
Guys, just going back to the new gold trade, it's one we haven't really spoken about lately. Interesting that you are still running it. I suppose it is working out, but to the extent that you were hoping it would work out, or has it been a bit of a disappointment?
It's very slow going. It is working, but it's working very, very slowly. I'm still looking for a target there of 140 Rand a share for new gold, but it really is taking its time to get there. But for now, I'm going to sit tight.
Okay, so a great performance, up almost 44% year to date. And just to end off with maybe a reminder on when next you are holding courses.
Yes, so the next one is on the 7th of July in Johannesburg. There are still 10 spaces open for that course. So anyone that's interested, get in touch with me, garth@traderscorner.co.za, and I'll send you the information. And then all my social media stuff you can follow there.
Your social media empire.
I've got 996 Twitter followers. I need 4 more to get to the magical 1,000. So if 4 more people wouldn't mind.
Maybe you have to offer them some sort of financial incentive, Garth. Bribe your way to a Twitter following.
There's Twitter and Facebook as well now, facebook.com/traderscorner.
All right, so we know where to find you. Garth, we have to leave it there. Thanks as always for joining us.
Thanks.
That is Garth McKenzie, the founder and editor of Traders Corner.